Hi everyone, good morning. Today we are going to discuss about the introduction to accounting. So I believe most of you, when we talk about accounting, you think about the financial statements, for example, the balance sheets, income statement and all that. And of course, throughout this course, you are going to prepare these statements, but before that we have to discuss the most important thing in accounting, which is the accounting equation. And as you can see in the slides, accounting equation is liabilities plus equity equal to assets, and we are going to discuss each elements in accounting equation, which are the liabilities, equity and asset accordingly. And let's take a look at the first element, which is the liabilities. And liabilities is the obligations for one particular company from the outsider. And in liabilities, there are two types. For example, the current liabilities and the non-current liabilities, or long-term liabilities and short-term liabilities. And these liabilities normally company use to increase funds for the company. Okay, they are, as you can see in the slide, there are examples for liabilities. For example, the loans and overdraft, creditors, and the last one is accrued expense.
So the next element that you can see in the accounting equation is equity. So earlier on, we have Dr. Shazro talking about liabilities. So besides liability as a method for you to get funds for the business, there's also another method whereby the business can get money to run its operation. So that other method, we call it equity. So basically, equity means fundings coming from the owner of the business. So as you can see from the slides, there are four given examples of equity. You have common stock, reserves, retained earnings, and owner's capital. So starting with owner's capital, which is the easiest to understand. So the name is already indicating owner's capital. So owners meaning any money that the owners brought into the business. So whichever money, if they brought in 1 million into the business, that 1 million will be recorded as owner's capital. Then if we move on to common stock, so common stock, another name for it will be ordinary shares. So these are usually for companies that are listed in the stock exchange. So companies that are publicly listed in the stock exchange will mean that any other individual out of the company can buy part of the ownership of the company. So any stocks that they buy from the company will be an injection of funds into the company for the company to be used as part of their operation. So that is common stock. Then if you look at retained earnings, so retained earnings comes from basically the income of the business. So whichever income that the company has in the previous years, all of it will be gathered in an account calling retained earnings. Then we also have reserves. So reserves are generally extra funds that the business has for it to run on its operation. So reserve generally would be part of their retained earnings along with all of their balances from previous year. And it gets accumulated, it will be moved to the reserve of the company. So those are examples of equities.
Okay, good morning class. Earlier my two colleagues have already spoken about liabilities and equity. So now I'll talk about the third part of the equation, which is assets. Basically, assets are resources or things of value which belong to the business. Assets are generally two types of assets: tangible assets and intangible assets. Today I will be focusing on tangible assets. Tangible assets are those assets which we can touch, feel and see. And examples of tangible assets include properties, plant and equipment, debtors and prepayments. So properties are long-term assets belonging to the business and used by the business in the course of running their business. Now on top of properties, another type of asset is plant and equipment. These are basically machinery and related equipment which are used to generate sales and other earnings for the business, and because they have a long life of more than 1 year, used for more than a year, so we consider them as long-term assets, and they're also tangible assets. So the next group of assets are debtors, which are basically people who owe money to the business. In most cases, they are repayable within 1 year or less than a year, so hence they are classified as current assets. And with another category of current asset is prepayments. These are those payments made by the business in advance, paid in advance. So this is considered as a prepayment. For instance, it might be an electricity bill, or it could be any type of utility bill which has been paid in advance. Therefore, it is considered to be a prepayment, and it is classified as a current asset, i.e. an asset which would be liquidated and converted to cash in a period of less than 12 months. So hence it is a current asset. So I would end my session here. If there are any questions, please feel free to ask.